Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons. He's Greg Willett. In our last episode of this show, we walked through the performance of the U.S. apartment market in 2013, and we promised to follow up with our outlook for 2014. So true to our word, here we are. We're fulfilling our first New Year's resolution, which was to film this episode. So Greg, start us off.
I feel like I've accomplished something already. So a good way to start, obviously, is to talk about the economy. And the story there is encouraging and maybe surprisingly encouraging with some of the numbers that have come out toward the end of 2013. The big headline grabber there was a 4.1% annual growth rate in GDP for third quarter. What we've also seen, the last couple of monthly job creation reports have come in above expectations. The retail sales numbers over the holiday period, not off the charts, but still pretty good. So again, a good story there. And really, I think summing it up is a quote from a paper that Moody's Analytics put out that said the U.S. economy should experience a breakout year in 2014. So obviously, if we have that happen, some really good housing demand, and that includes some very good demand for apartments, our expectation is that across the top 100 metros, that we're going to absorb 175,000 apartments, up meaningfully from the 2013 volume.
And a significant upturn in the economy, and specifically for apartment demand, would be very well timed because the apartment sector is going to need it. Across the top 100 markets, scheduled new supply reaches 234,700 units, and that compares to about 155,500 units that completed in 2013. And something that we're seeing right now is that delivery timing is getting dragged out, partly due to some construction labor shortages in certain parts of the country. It wouldn't be surprising to see that 2014 construction number, or completion number, I should say, come in a little under that scheduled number that we just told you. But even taking that into consideration, this coming year's new supply number is going to be pretty hefty.
So let's compare those demand and supply numbers, and what do we get there? Is the expectation that occupancy is going to backtrack just a little bit. So we ended the year 95% even. We think that we'll end 2014 at a rate of 94.6%. So backing off some of the highs that we've been at, but and moving a little bit more toward the long-term norm. Some variation by product segment, and we've been talking about this for a while, and a little bit more competitive environment at the top end of the market because of that new supply coming online. But again, really tight occupancies in that middle market and lower end product, and that's probably not going to change in 2014. Won't be impacted by those new completions because you're really talking about residents who can't afford that new product, they can't afford to buy homes, so really tight market conditions in that middle market, and then to some degree also in the bottom end. And while variation really reflects that product segmentation, there's some neighborhood implications there as well. Since the top end of the market is heavy in the urban core, and that's where the construction is, those are the areas where occupancy is probably going to backslide a little bit as we're in 2014 versus stronger occupancy rates actually in the suburbs.
And not surprisingly, we'll see some pretty similar patterns on the rent side. Overall, right now in 2013, the U.S. apartment market had rent growth of 2.8%, and we think that number will come down just a little bit in 2014. We're pinning that number at 2.6% year-over-year rent growth in effective rents for new leases. Following that pattern that Greg talked about, the occupancy outlook, there's going to be some significant variation by product niche and submarket. The more competitive leasing environment should be at the top of the market, with rent growth at top-tier product likely to average at best around 2%. And there are going to be some urban submarkets with a lot of new supply underway, a lot of Class A communities coming online that may be lucky to achieve any rent growth at all. On the other hand, the outlook for continued rent growth topping 3% looks pretty good in the middle market and low-rent properties. And keep in mind that these lower-end, more moderately priced units comprise the vast majority of the total apartment stock.
Also impacting the rent growth numbers at that middle and bottom end, there's some product upgrades going on.
Yeah, something that makes us feel a lot better about the rent growth prospects for the middle of the market is just how much value add activity is occurring right now. There are lots of significant renovations taking place in middle market communities that have been changing hands. Obviously, transactions have been significant volumes right now. And even if a property does not have a new owner, quite a few folks are thinking that now is the right time for at least moderate upgrades for long-term asset preservation. And thus, the outlook for substantial rent growth in these middle-range apartments doesn't reflect just the market conditions. It also reflects that we're tending to juice up the product quality.
A couple of other factors to talk about as we look at what's going to happen in 2014. We've said that completions will be up, but I think it's interestingly, starts, we think, go in the other direction. And in terms of the new properties that are getting underway, we'd anticipate at least a 10% decline in that relative to the 2013 volume, maybe as much as 20% there. Capital flow is the big deal that shapes that, and certainly there is a lot of capital out there chasing apartment deals at this point. But at the same time, some other investment options beyond apartments that haven't been on the table for a while seem to be coming back into consideration, and really looking at getting individuals done. Almost any capital source is going to be very willing to do a slam dunk deal if you bring that to them and ask for some cash there. But those slam dunk deals are just getting harder to come by there, as we're in this environment where interest rates are expected to go up, and certainly construction costs are going up a lot, both for materials and for the labor market. So again, fewer slam dunk deals there. And then another factor probably slowing down the start volume. Not a lot of fantastic sites available right now. This product that is finishing up at this point, a lot of that is on legacy sites from the last building cycle. And so for this cycle, we're really just starting that process of getting the entitlements and the prep work and really getting everything ready to go. So again, we think a little bit of a lull in starts.
Another point to hit on for 2014 is the expected trend in transactions, and our forecast calls for a meaningful bump in sales activity. And influencing part of this expectation is that we're seeing a lot of folks moving down the risk spectrum from their preferred strategies. Core players are eyeing urban sites in some secondary markets. Class A buyers are looking at Class B deals. Secondary market players are starting to look for those hidden gems in tertiary markets. And really, this is hitting on a trend that actually started in 2013. You take out a couple of the giant portfolio trades that occurred in the past year that were really top quality product in some core areas, and you see the transaction pattern has already moved down that risk spectrum to some degree. And also, the investors are obviously chasing some higher yield as well. Now, having said all that, there is some potential that core sales volumes do pick up again, and or at least could prove to remain substantial, I should say. Now, even with cap rates remaining very, very low, investors are lining up for that type of product, and with some of that product, some of this new product that's just coming online in these core submarkets, these Class A deals and some core submarkets, some of these merchant builders may be looking to flip those properties pretty quickly.
Yeah, I think this new product coming online is going to start trading very, very quickly.
Yeah. So, Greg, lots for the audience to chew on in terms of what to watch for in 2014. Any final words of wisdom?
Well, and not new words, but I'm going to repeat what I keep saying over and over, that this cycle is about the length of the cycle and solid returns over an extended time frame rather than what you're going to do in any individual year.
So there you go. That's what you have to watch for in 2014. So until next time, thank you for watching Apartment Market Dynamics with Greg Willett. I'm Jay Parsons.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.